project. I'm assuming you have some people do Shake Shack in the corporate finance or in the past. Is that true? Or
Probably not, because it went
no?
public only 6 months
really?
ago.
Okay. Because I'm trying to do Shake Shack, and the structure is they have
These are from perspective.
One more?
Yeah, just that one.
Okay. So those of you who've sent your DCF valuations already, I think I went through the entire list this morning and sent them all back. So if you sent it and you haven't got it back, it's either because you got the subject off. And don't be creative, please. I said my perfect. I know some of you decide to be funny and say my imperfect DCF valuation. You know why I ask you to put that same subject, right? It goes into a smart mailbox, and the mailbox is not that smart. So if you make it imperfect, it says doesn't match up. It puts you into my regular. And so if you sent it and it hasn't come back to you, it's probably because the subject is off. Just resend it with the right subject matter. Second, I've been getting quite a few emails from people who have something around December 18th and asking whether I'd give an early final. I'm surprised I'm getting those emails, because if you've been in class, I've been saying repeatedly, there is an early final. It is December 16th. I can even give you the time. It's probably going to be 10 to 12 on December 16th. Somewhere along a week before December 16th, I'll open up a Google shared spreadsheet, so I have a sense of how many people are taking the early final. My guess is about 50 people, given history, will end up taking it. It's not optimal to take it on the 16th, because our last class is on the 14th, and your project is due on the 14th, so you might not have enough time. But if you have plane trips to make and reservations to get in place, if you want to take the early final, that's okay with me. Okay? So let's start today. Today we're going to do the fun stuff. Up till now, we haven't valued a single company. Have you noticed that? Not one. Other than the valuation of the week, which most of you are not even aware is going on. Okay? But we haven't really valued a single company in class. So today we're going to start valuing companies, and we're going to move at hyper speed. And here's why. The inputs we've talked about, the hard work is done. If you understand cash flows, growth rates, terminal value, the loose ends, the valuation itself is almost an afterthought. There's really nothing to do. So let's start today's session with a few of the issues that might not come up today, but somewhere along in the next two sessions will come up. Okay? So here's the first one. Let's say you're valuing a company with horrible corporate governance, and I'll let you in your mind figure out what that actually means. It's badly managed and badly run. You do a discounted cash flow valuation of the company, and you come up with $100 million for the company. So you can put a lot of Asian, Latin American, even US company names in there. Now, should I be discounting this value for bad corporate governance? Why not?
Because you've already put everything in
But how did I do that? Where did it show up?
growth and your discount rate.
Every single input in my valuation reflects the fact that you're badly managed and badly run. What does that mean? You took projects that make a 5% return on capital, your cost of capital is 10%. You chose to fund yourself entirely with equity, even though you could borrow money. It's something I want you to keep in mind, because you see this. We talked about the loose ends where people come in and premium and discounted cash flow valuations like they're going out of style. Remember, if you control the inputs, you've already brought in a lot. That's why with Ferrari, we didn't add a brand premium on top of the valuation, because the numbers these are your numbers. They didn't come from outside, so they already reflect poor corporate governance. You're saying, we'll then ask the question, what if governance changes? That's an interesting follow-up question, right? What if this company's governance is changing? How do I bring that in? We'll talk about that as we start valuing these companies. Here's the second one. Let's say you've done a discounted cash flow valuation for a pharmaceutical company. You can put in whatever company's name you want. You come up with a value per share of $20, but in doing this, you use conventional accounting. You know what I mean by that, right? R&D is expense to income. So you basically took all the numbers from conventional accounting. Last moment, you remember class, and you say, oh my God, I should have capitalized R&D. And the nice thing about capitalizing R&D in the spreadsheet is you change the no to the yes, and you enter the numbers, it'll capitalize the R&D for you. So the only change you made is you capitalized R&D. If you capitalize R&D, which of the following will happen to your valuation? And I'll go through each one, and if that's what you think will happen, make that choice. Nothing will change. It should remain unchanged. If that's actually the answer, we wasted our time on the R&D section, right? So clearly that can't be right. So you can cross a line through that, because if nothing changes, who cares? It is true the free cash flow to the firm from last year will not change, but other things about the company will change. It should go up. Why? Because earnings will increase when R&D is capitalized. Is that true? Think back to quiz 1. What's the adjustment for R&D? You take the earnings, you add back the R&D expense, and then you subtract out the amortization of R&D, right? So if you have flat R&D over time, your earnings actually is unchanged. If your R&D is decreasing over time, your earnings will actually go down when you capitalize R&D. If your R&D is increasing, it's true your earnings will go up. So that statement is not even true. Earnings don't actually go up. It should go down because reinvestment will increase when you capitalize R&D. Again, depends on whether the amortization exceeds the R&D expense. It is true. Conventional CapEx will look much bigger if you capitalize R&D. So in a sense, I've kind of talked you into the answer, I hope. The answer is, it depends on the company. You know what it's going to tell you? When we capitalize R&D, what are we doing? We're raising R&D to the level of any other investment, right? Any other, you build a factory. Is building a factory good for your value if you're a manufacturing company? It depends, right? It depends on whether the return on capital you make on that factory exceeds the cost of capital. We've essentially brought R&D to that same test. If your R&D is good R&D, and good R&D is R&D that increases value, capitalizing R&D will increase your value. So if you're a company that has done R&D efficiently, your value will go up. If you're a company that has done R&D inefficiently, in other words, you've spent tons of money on R&D and your earnings haven't changed, then your value will actually go down, and that's the way it should be. R&D is neither good nor bad. It's just a way of investing. And we have to ask, is it good investment, neutral investment, or bad investment? Last question. Some of you are valuing distressed companies, so I thought I'd bring this in today's session in case you're struggling with this. You're valuing Glencore. You come up with a discounted cash flow valuation of the company. So you make assumptions, and let's say you make realistic assumptions about margins changing over time. You bring in a high cost of capital, you do a discounted cash flow valuation, you come up with a value of $1 billion for the company with a discounted cash flow valuation. You see, why do you keep saying that? You're going to see in a minute why that statement's going to be critical. Given that this is a discounted cash flow valuation of a distressed company, even if you've been completely realistic about all your assumptions, is your value going to be just right, too low, or too high? It's going to be too high, and why is that?
Because you haven't taken into account the possibility that it will go bust.
But I used a higher discount rate. I'm playing devil's advocate. You're actually right. Keep in there. It is true, I pushed up the discount rate, but I'm still assuming what about the company? It's going to be a going concern. Remember that discounted cash flow valuation is built on the presumption that your company is a going concern. You see, as opposed to what? As opposed to the fact that the company might not make it. Discounted cash flow valuations are horrible at dealing with truncation risk. You know what I mean by truncation risk? The risk that your company will not make it. So distress is one. You know what else is in there? Nationalization risk. If you ask me to value a Venezuelan company, I can't adjust the discount rate. It's a blunt tool. It cannot be used to reflect that kind of risk. So I can bring in a higher cost of debt with a low rating, but I'm still never going to be able to fully capture the effect of, hey, what if this company doesn't make it? You could, but you have to explicitly bring it in, right? Because in a sense, in a discounted cash flow valuation, where are you going to slip in the liquidation value and when? But remember, you might not make it to year 5. That's really the problem you're facing. So even though your liquidation value might be low, you're reflecting it in year 5. But the problem with truncation risk is you might not make it through the next 3 months, the next 6 months. It's the uncertainty about the fact that you will never get to nirvana, which is what terminal value is, right? So adjusting the terminal value is not going to do it for you. So we'll talk about mechanisms you can use. And some of you will have to bring this mechanism in. Without it, your company will look like an incredible bargain. I'll tell you before the fact that if you're valuing Glencore, the company is going to look incredibly cheap to you. But don't do anything rash until you brought in the distress risk issue. So let's go back to the notes, because I want to say a couple of things about narratives and numbers before I move on. Because as I was looking at your DCF valuations, here's the question I was asking in addition to checking your numbers. I was asking, what's the story you're telling me about your company? And that's what I want you to think about, is as you send in your DCF valuations, even though you might not write the story out for me, in your head I want you to think about what's the story I'm telling about this company. So as an example, Apple is coming out with an earnings report tomorrow. Huge event for the market. You're going to see Twitter feeds light up around 4:01 tomorrow, right after the report comes out. I've been valuing Apple every 3 months now for almost 5 years on my website. And for the last few years, my narrative has been pretty much stuck. The way I valued Apple is as a low growth company with margins that are going to shrink. Why low growth? Because what's its biggest market now? Where does it make most of its money? 65% of its revenues come from the iPhone. The smartphone business is starting to flatten out. Why? Because I'd wager if I went around and said, how many of you have flip phones? Does anybody here have a flip phone? We all have moved to so that part of growth is behind us, right? The replacement. So now you're looking at a market that's pretty much getting saturated. The market's not growing very fast. You're saying, well, maybe Apple can increase its market share. At whose expense? There are only 2 big players, right? Apple and Samsung in the market. So it's a big market share company in a mature market. So in my story, there's low growth and declining margins. Why? Because in a sense, as the market matures, you're going to start to see price wars. Now, Apple's been pretty good so far. So in my valuation, I gave it, 4% revenue growth for the next 5 years, dropping off very quickly to maybe 1.5% growth beyond year 10. And I have margins going from what they are now down by about 5% over the next 10 years. In spite of those assumptions, which are pretty pessimistic according to most people, the value I get is about $135 per share. Or actually with the stock split, $67.50 if you know. So essentially it looked undervalued. I did this in August right after the stock had dropped to about 15%. I said, looks cheap to me given my story. But that's the story I was telling. Tomorrow when the earnings report comes out, you know what I'm looking for? Is there anything in that report that changes my story? So if all I get is iPhone sold well, revenues are up 4%, margins drop by 2%, my story in a sense stays intact. You know what would change my story? If they reported a surprise. What kind of surprise? Not that their smartphones grew a little faster than I expected, but that the iWatch is selling 10 times more than I thought it was. Do you see what I'm looking for? I'm looking for changes in my narrative because those changes affect my valuation. In my original narrative, I said Apple's grown through disruption, but it's going to be very difficult for them to continue to be a disruptive company because when you're the largest market cap company in the world, your next disruption has to be huge to make a difference. The iWatch could capture the entire Swiss watch market. You probably wouldn't even notice it. in Apple's valuation because it's a small market. So it's got to be going beyond the traditional watch market, and maybe tomorrow's story will deliver a surprise in either direction. Maybe the negative surprise will be that nobody in China, throw the China in, just for effect, is buying iPhones. Because they're buying that, what that Xiaomi, is that the cheap Chinese? Yeah, that everybody's decided to switch. That would be a game changer. So when I talk about narratives, that's what I want you to keep your eye on. Tell me a story right now, but don't get stuck on that story. As the world changes around you, you have to adapt. The worst thing that you can do in valuation investing is say, I have a story, it is a good story, I will not let go of that story no matter what happens, because that's how we get into trouble. It's not easy to do because you have to say, look, I was wrong. I have to go back and change my story. So as these next few weeks you see earnings reports come out, think about that when you think about how does that affect my value. Don't worry about what the market does. Markets react to strange things because that's a pricing game. Then we'll come back and talk about what they react to. You have to be thinking about game changers, narrative shifts, narrative tweaks, narrative changes, or narrative breaks. Those are the scariest. Narrative break basically means you're getting a message saying your story doesn't work anymore. I'll give you a couple examples. Ever heard of this company, Aerial? But a year and a half ago, they were a high-flying company with a lot of venture capital money. And what they were offering was a product where you could watch cable channels on your device without paying cable fees. Sounds too good to be true, right? They claimed they'd found this technological tweak that allowed you to do this, and you could actually watch cable channels. Of course, the cable companies thought this was all illegal, and they went to court. Last June, a year ago, summer ago, the Supreme Court finally ruled on that and said that what Aerial was doing was illegal. The minute that judgment comes down, what happens to the value of Aerial as a company? It's gone. It completely disappeared. That's a narrative break. Here's another one. You're a lead investor in Ashley Madison. Man, a few months ago, it was this high growth company. A lot of cheaters around the world. You're saying, I want to be part of the cheating business. Not because you want to cheat, but you want to make money off other people cheating. And of course, that story blew up a few months ago because the one thing cheaters don't want is that everybody to know they're cheaters. And when all those email addresses went public, the company blew up. That's a narrative break. And especially early in a company's life, this can happen, narrative breaks. As a company matures, it's less likely. Though you watch a company like Valiant fight through what it's fighting through now, they're fighting a potential narrative break, right? I mean, they've lost 50% of value because their reputation, the story that was told about the company as it soared was, this is a company that doesn't do business the way pharmaceutical companies do, throwing a lot of R&D. It basically buys technology and then maximizes revenues, but now potentially at least there is a crack in that story as to whether this was real or whether this was somehow manipulated, and that is at the core of why it's going to be difficult to value Valiant right now. I've had at least a half a dozen emails in the last week saying, how come you're not valuing this company? And I said, look, it's a company where I'm not sure what the story is right now. If I had already invested in the company, I'd have no choice. I have to confront the story. But if I'm not invested yet, I'm going to let this play out. In fact, their presentation was this morning at 8 o'clock. I didn't get a chance to watch it, but I'm probably going to watch it just to see what they say. So that's narrative breaks. Narrative shifts and changes are much more common, and that's what you're looking for in earnings reports. With a Twitter valuation, for instance, my narrative for the last couple of years has been, it's a company with a great resource, 315 million, pretty involved users, but it hasn't figured out a way to convert those users into revenues. You know what would break that story open is in the next earnings report they started delivering. It doesn't have to be big. It has to be a way of advertising that somehow connects with those users, because the minute that happens, that $31 value is going to go to 55 or 60. So as somebody investing in the company, Last week when Steve Ballmer invested in the company, somebody emailed me and said, what does it do to your valuation? What does it do to your valuation? Nothing. What do I care if Steve Ballmer invests in the company? The cash flows don't change, the growth doesn't change, the risk doesn't change. It's not like he has some deep insight into this business that's going to make me blow up the valuation. But what would make my valuation change is something in that earnings report that says, hey, finally they've cracked the code. Yeah. I'm sorry?
Weight Watchers?
Weight Watchers and Oprah, again, if you're valuing Weight Watchers, is your value going to be higher post-Oprah than pre-Oprah? No. Why? Because there's nothing, again, that changed in your valuation. But could the price be higher? Yes, pricing is a different game. Okay. So think about that, and even small things can affect your narrative. And I'll close with an Uber story. Last year and 3 months, this is one of the most fascinating things about valuing Uber. Every day I open up the paper, and there's a news story on Uber. This company is a magnet for news stories, right? And every time I read the news story, I have to think about how does this affect my valuation of Uber. So during the summer, you probably read that the California Labor Board decided to treat Uber drivers as employees. Does it affect my valuation? Absolutely, because in my original story, I treated them as independent contractors. My expenses reflected that. Now that they're employees, I have to bring in not just the additional expense of Social Security tax and whatever else you have to pay. I have to factor in the possibility that they could unionize and negotiate for better terms, that 20% could become 10%. I also have to factor in that now that they're employees, that if you get sued, an Uber driver does something crazy, you can sue the company as well. That changes my valuation in a bad way. But the next day you open up and say Uber delivery is working really well in LA. That's a story that changes my valuation in a good way. So that's why I called it a roller coaster, because one day you're getting news that shifts your value but you have to leave the door open. And to show you how much even small things can change it, I'm going to close with this. A year ago in August, my son, who was then 15, had a friend over. I live in the middle of suburbia, and you'll notice why that part of the story is critical. Had a friend over. A friend stays all afternoon. 6 o'clock, it's time for his 15-year-old friend to go home. And usually in suburbia, the transportation device that takes a 15-year-old boy home is called the mom car. It's usually, sometimes the dad car, but usually the mom car. If it's 6 o'clock, the mom car is, the mom drives the car into the driveway, says, son, time to go home. So 6 o'clock comes around, car pulls into the driveway. It's a sedan. And there's a guy with a beard sitting in the front. I said, has your mom grown a beard? And he said, no. So whose car is that? He said, it's an Uber. My first reaction is, I've got to get back to my spreadsheet. Do you see why? Because remember the original story I told in June for Uber? What did I call it? An urban car service company, right? And where am I? In the middle of suburbia. And a mom has entrusted a third or fourth or fifth most precious possession, depending on where that kid, how he behaved that day, to Uber. That changes the story. So if those are the kinds of things that can affect your valuation, especially when a company is young. Small news stories can make big differences in your valuation. So let's start valuing companies. As I go through these valuations with each one, yes? Yeah. No, wait, back up. When you go public, what changes about your company? Absolutely nothing. Absolutely nothing. Cash flows are the cash flows. The growth is the growth. The risk is the risk, because in a sense, if you look at who's invested in Uber right now, it's Goldman and Fidelity. It's the same people who'll be. Nothing will change. The one thing you got to keep in mind is when you do go public on the offering, you're going to get cash. And you have to look at what the company does with the cash. What are the three things you can do with the cash? One is you can use the cash to pay down existing debt, right? In which case your debt ratio changes. The second is owners can take the cash out. They can cash out. That's what's happening in Ferrari. And that's your easiest scenario, because that happens, you can just ignore it. Or third, the company can keep the cash to cover future investment needs. I'll wager with Uber it's going to be number 3. And if that is the case, here's the one change that's going to happen to your valuation. The minute after the offering, you know what's going to happen to your cash balance? It's going to jump by however much they raise on the offering. That is the only change. So on the day Alibaba went public, because it was a $10 billion cash offering, that $10 billion increased their value by $10 billion that day. It's neither good nor bad. It's just the fact that the offering makes them a more cash-rich company after the offering. Nothing else changes. Just like Oprah Winfrey buying Weight Watchers doesn't change valuation. Just the fact that a company goes public can't make it a more valuable company. Right? So now, as we go through these valuations, you're going to see equity risk premiums kind of go all over the place. You're going to see 4%, 6%, 5%, rather than with each valuation explaining where the equity risk premium is coming from. I'm going to lay the table on all the equity risk premiums you might see in the next 25 valuations. In my pre-1998 valuations, I used to use a 5.5% equity risk premium. That was actually a historical risk premium before 98, reflecting my trust that, hey, things always revert back to the way they used to be. Between 98 and 2008, you're going to see a lot of 4% premiums, reflecting the average implied premium of that period was about 4%. Post-September 2008, my premiums have become month-specific. So you'll jump around 6, 5, 5.5. So if you're wondering, why is this premium changing? It is because the month in which the valuation was done, that was the implied premium for the S&P 500 at the start of the month. And if you have other country exposure, everything gets adjusted to it. So let's start easy. I call this my training wheels valuation. Before we go off and start valuing young growth companies and distressed companies, let's start with a nice, money-making, dividend-paying company with low growth. Value Con Ed, regulated utility. And here's why I think the valuation is going to be simple. In August of 2008, if you looked at Con Ed, they were paying about 73% of their earnings as dividends. So I'm going to use a stable growth dividend discount model to value the company. Remember how restrictive that is, right? I'm focusing on dividends as if they were cash flows. I'm allowing for a growth rate that you can sustain forever, which means it has to be less than the growth rate of the economy. And then I have to make sure it's behaving like a stable growth company. So before I decide to use that model, it's a very simple model. Here are the tests I ran. First, I said, is the firm paying dividends like a stable growth firm? And it is. You know, you're saying what number there would fail the test? If the payout ratio were 20%, and I said this is a stable growth firm, internally that story has a problem, right? Because if you're retaining 80% of your earnings, then where's all that money going if you're growing at 2% a year? So that test got passed, 73%. Is the growth rate that I'm going to use, because remember, I'm assuming going forward that they're going to have a really low growth rate. Is the growth rate that I'm getting from the fundamentals I'm computing for them consistent with stable growth? And here's how I computed that. I took the 27% retention ratio, which is whatever the payout ratio is not, and I multiplied by the return on equity, which was roughly equal to their cost of equity of 7.7%. 27 of 7.7% is 2.1%. That's what I'm assuming is my growth rate. You know what I want to compare that to? My risk-free rate at the time that I did this was 4.1%. It's lower than the risk-free rate, so it passes that stable growth test. So my dividends look like they're of a stable growth company. My growth rate that I'm getting from fundamentals look like they come from a stable growth company. The final test I run is, are the cost of capital numbers consistent with what I'd expect in a stable growth company? The beta that I used to 0.8 reflect the betas for regulated utilities. It's pretty consistent with the stable growth company. The equity risk premium I was using in 2008 was 4.5%, and the risk-free rate was 4.1%. All of the numbers here suggest to me that I'm going to be okay using a stable growth model. As a final test, remember when you use dividends, what are you assuming? You're assuming the company pays out what it can afford to in dividends. I looked at what their free cash flow to equity was each year, going back in time. And while that free cash flow to equity tended to jump around, on average, over the last few years, they paid out 97% of their free cash flow to equity as dividends. I just hit the jackpot. You have a company that's paying out roughly what it can afford to in dividends. That payout is a big chunk of earnings. The growth rate is lower than the risk-free rate. The value that I'm going to have for the equity is the $2.32 in dividends from last year, grown out 1 year at 2.1%, divided by the difference between the cost of equity and the growth rate, gives me a value per share of $42.30. You're probably saying, I wish I'd picked this company to do my discounted cash flow valuation. Hey, you still have a chance. Friday at 4 o'clock, you haven't done your DCFs. I've switched companies to Con Ed. I'll let you get away with it. I mean, it's in a sense, you know. It's your, as I said, you're not going to learn a whole lot. If this is the entire valuation, this class could have ended 15 minutes into the class. Expected dividends divided by cost, $42.30. Stock was actually trading at $40.76. I'm actually going to use this very simple valuation to talk about a couple of mechanical questions that often come up after you've done an intrinsic valuation. So I value the company, I'm getting $42.30, the stock is at $40.76, right? What are the three possibilities at this stage? The market is right and I am wrong. That I am right and the market is wrong. What's the third possibility? We can't both be right, but we can both be wrong. Because in a sense, it's not like the market's trying to estimate the true value. I'm trying to estimate the true value. But one of the questions that we all face when we do evaluation is, I've come up with these assumptions I've made about growth and risk. What would need to be true for me to get the market price as my value? I'm not saying that's what you should drive your valuation towards, but it's always a good question to ask. So what I did was I kept everything else constant and I changed just the growth rate. Remember the 2.1% growth rate? At the 2.1% growth rate I got $42.30. I changed the growth rate and at about 2.06% I get a value equal to the market price. You're saying, so what? Valuation is about how much buffer do you have on your mistakes. So if you ask me to characterize Con Ed as undervalued, fairly valued, or overvalued, where do you think I'm going to end up? I'm probably going to go with the fairly valued. It's undervalued technically, but the difference between my value and the market price, especially if you think in terms of assumptions, is small enough that I'm going to say, look, it's within the margin of error. So this is a fairly valued company. So keep that in mind. When you finish your valuation, you have your value at the market price. There's a very simple way you can back out an imputed number in your market price. Use the solver function or the goal-seek function in Excel, because you got your value there. Solve for whatever, but pick only one input, because obviously Excel can't deal with multiple variables changing. Pick whatever number you're least certain about, your growth rate, your risk, your cost of capital, and say, you know what does that number have to be for my value to be equal to the market price? That's not going to be your valuation, but at least you can get a sense of how different can I be from the market and still get away with it. Yes?
How big do you consider your buffer when you're considering?
Depends on the company, right? I mean, that's why there's no one answer. It can't be 15%, like some value investors say margin of safety has to be 15%. With Con Ed, it might be 5%. With Twitter, it might be 35%. Right? And that's, I think, the judgment call you have to make. Is there is no one number that I can give you and say, if that buffer is greater than this percentage, it's undervalued. It's going to be a function of the company, and it's going to be a function of your gut, how risk averse you are. Because you can't change that. That's the way it is. So that's my break-even growth rate. Now let me go back to the 42.30 that I estimated the value, the 40.76. And let's assume you become a sell-side equity research analyst. My sympathies, but that's your job now. Sell-side equity research analysts never tell you the value today. For some reason, they have this target price fixation, which means rather than give you what they think the value is today, they feel this urge to give you an expected value a year from now. So let's say you have to play that game. You have an equity research report. The managing director says this intrinsic value stuff doesn't work for me. I want the value, the expected stock price, the target price a year from now. Assuming you believe your valuation, which is 42.30, can you tell me the expected target price a year from now? How do you get that? In other words, how do you go from a value per share in a DCF, which is a value today, to an expected price 1 year from now, 2 years from now? Because that would be neat if you can pull it off, right? Because you can give target prices 5 years out. How would you do it? Think back to the cost of equity. What exactly is the cost of equity? It's a rate of return you need to make on this stock to break even, right? And you've now told me that at 42.30 you think it's fairly valued. So what should your return be next year if 42.30 is a fair value? What should your return on your stock be? Roughly 7.7%, right? Because that's what fair value means, is you're going to earn your cost of equity. So next year your expected return is going to be 7.7%. You're almost there. Some of that is going to come from dividends and some from price appreciation. Do you see where I'm going to go next? I'm going to take the 42.30. I'm going to grow it out at 7.7%. I'm going to get an expected value a year from now. That's not going to be my expected price because some of it is going to come from dividends, and my expected dividend next year is going to be $2.32, growing at 2.1%. And I think I worked it out. Let me see if I did work out the numbers. I think I come up with $44 and so the expected, oh shoot. Expected price I get, so basically it's $43.19 because I get 7.7%, you net out the dividend, my expected target price a year from now is $43.19. Is everybody clear on what I did? I took the 42.30, which is my discounted cash flow value. I attached a 7.7% expected return, and then I subtracted out the dividend, saying the rest of it is what comes from price appreciation. That's my expected price 1 year from now. What if I ask you for a target price 5 years out? You have to do this over 5 years. Take 7.7% over 5 years. Take your dividends and grow them out over. You can basically give me target prices for as long as you want on any discounted cash flow valuation. It's a neat mechanical device you can use. If anybody asks you, you've got a DCF value, but I want to know what the value will be 5 years out, 10 years out, you can take your DCF value and answer that question. So everybody comfortable with that? Okay. So if you bought the stock today at 40.76 and your valuation is right, what should happen? It should jump to 43.19. Plus you get the dividend, your total return is going to be about 13 or 14%. Why 13 or 14%? Because if your valuation is right, then this stock is undervalued right now. And the way it shows up is you get a much higher return over the next year, the next 3 years, the next 5 years. So that's why discounted cash flow valuations are still useful, even if you have to provide a target price. So don't do stuff like moving things across time, trying to do a DCF 1 year out. You don't have to. You can just take the value today and get those projected values a year, 2 years out, 3 years out, 5 years out, 10 years out, if you so desire. Let's take a second valuation. We're still going to stay humble. We're going to take an easy company to value. We're going to value 3M. What does 3M do? Incredibly boring stuff that makes a lot of money, right? Like that technological marvel, the Post-it note. The guy invented that should get a Nobel Prize for something. Different colors, but it still makes them a ton of money, hundreds of millions of dollars. So it makes all this small stuff, tape, paper. And this is a valuation I did on September 12th of 2008. The date is significant. What happened at the end of the day on September 12th? Lehman essentially went belly up. And on Monday, September 15th, we woke up to the nightmare. So this is actually a valuation. I did that Friday, not knowing, and I'll make a confession right now. On September 12th, I didn't see the crisis coming. I'm sure you did, I'm sure Robert Schiller did, I'm sure there's a ton of people who claim to have done. Everybody seems to have seen it coming, except me. So I was valuing it during the day. I was valuing it for some reason, I don't know why. And the value per share that I got was $83.55. A very conventional free cash flow to the firm valuation built off fundamentals. So basically I assumed that they would do the status quo, which was not reinvest very much, 30%, but reinvest very well, a 25% return on capital, giving them a 7.5% growth rate. And I discounted all back at a cost to capital that reflected the world as I saw it on September 12th. An equity risk premium reflecting the 4%, was a pre-crisis premium, again because I didn't see this. So this is actually a real-time valuation. I come up with a value of $83.55. stock was trading at $70 per share. What should I have been doing right after the valuation? Buying. I was lazy. I said, I'll wait till next week. Thank God I did. Okay. Wasn't something that said, don't buy it now. I could make up stuff now. I really was too lazy. I said, this is Friday. Who wants to do this on Friday? I'll come back on Monday. What's going to happen over a weekend? Well, of course, you know what can happen over a weekend. You woke up on September 15th, the world kind of imploded on you. So I revalued 3M about 5 weeks after this valuation. And the reason I say the 5 weeks is no new information came out about the company. Nothing. And what are you told often if you're a value person? If nothing new has come out about your company, your value shouldn't change much, right? To show you how much of a lie that is, I revalued the company a month and 4 days later on October 16th. And of course, I had to be realistic. I can't say, look, it's September 12th. I'm going to act like it's September 12th for the rest of the time. I'm in a crisis. It's a macro crisis, but a macro crisis affects my story for 3M, right? Because 3M lives off the economy. If the economy is now going to grow slower, that's going to affect 3M as a company. And here are the places where I reflected it. No new earnings report had come out. But in a sense, by October 15th, it was clear that the economy was going to feel, this was not some small bear market, it was a change in economic. So I assumed that the recession would come. I looked at past recessions, and it looked like 3M's operating income didn't drop by much, by about 10%. So I lowered the operating income by 10%. That was the first change. Why 10%? Because 3M's history suggested only 10%. If I'd been valuing a technology company, this might have been 40%. Because their operating income was down, I also assumed that they would scale their reinvestment, become more conservative, which in turn, and lower the return on capital, which reduces my growth rate from 7.5% to 5%. So on a company level, the big changes are lower operating income, lower growth to reflect the environment I'm in. Let's go below the line and see what changes here. First is, their rating did not change, but the default spread did. That can happen in a crisis. That's what will happen. You take a BBB rated company. Before the crisis, the spread was about 1%. By the time you got to the middle of the crisis, that was 2%, 3%, 4%. So in a sense, the default spreads can change even if your rating doesn't change. So I used a higher default spread. And look at the equity risk premium. You know what that reflected? The implied equity risk premium had shot through the roof. The 4% on September 12th had become 6% by October 15th. And I built that in. So there's half of the changes are coming from the company getting into a recession, and half of it are coming from the world changing. The price of risk has changed. And guess what? When the price of risk changes, the value is going to change. The value, which was $84, went down to $60.53. Stock price had dropped to 57, close to fairly valued. In fact, 3M went as low as 45, which is when I revalued, and I did end up buying at that time because I wasn't too lazy. But it's a moving target, and that's what you have to remember. You have a value. People say, but the value is changing so much. You think the only thing that's changing is the value. What do you think about the price? It's changing as well. This is not about is your value changing, but is your value changing by more than the price? Is your company going from undervalued to overvalued, or overvalued to undervalued? Because that's what triggers your particular decisions. So all I'm saying is pray and hope that there isn't a crisis on December 12th. Because in a December 11th valuation, you thought you were all done. On December 14th, I'm not going to make you redo the valuation, but then you should be much more reluctant to act on it until you've looked at the numbers again, because it's not just about your company, it's about the world around you. And this is what makes valuing in emerging markets so much more difficult, right? Because the macro winds swirl around you all the time. And you can have a company that looks stable, where not much is happening, but the world changes around you, your valuation would reflect it. So we've looked at Con Ed, we've looked at 3M. Again, so with each valuation, what I'm going to do is I'm going to focus in on one specific point on that valuation rather than go through every input, because that'll be just repeating what we've talked about. Now I'm going to try to value an entire market. You think, can you? Sure, why not? A market, when I buy an index, I'm getting a collection of cash flows, right? In fact, this was the week 3 valuation challenge, I think, where I value the S&P 500. And this is something I've been doing probably 25 years. At the start of every year, I value the S&P 500. So let me try on January 1st, 2015. I initially decided to go simplistic. I decided to value the S&P 500 using a dividend discount model. In other words, I looked at the dividends paid by S&P 500 companies, which was 38.57. Those are index units, so basically everything gets scaled to the S&P 500 index. I put in an analyst estimate of growth. You're saying, but why are you using analyst estimates of an intrinsic value? We'll come back and talk about how sensitive it is to changing that assumption. 5.58%. I assumed after year 5 the growth rate would drop to the risk-free rate. Remember my rationale that I offered earlier, right? The risk-free rate is a good proxy for nominal growth. And I discounted back at a cost of equity. And one of the nice things about valuing the S&P 500 index is I don't have to spend too much time estimating beta because it is the market. I used a beta 1. Risk-free rate plus equity risk premium, 5.11%. The value that I got from the dividend discount model was $8.95. If you're an investor, you're blowing up your portfolio at this stage, right? Because the index was actually trading at 2,058.90. Dividend-focused investors find this market almost impossible to comprehend. They use things like the dividend and say, I would never buy stocks now. Look, the dividend. But what am I missing when in this particular valuation? Think back to, I'm missing the fact that increasingly US companies have shifted away from dividends. By focusing on dividends, I'm missing the rest of the cash being returned. So here's the first fix I made. I went from dividends to dividends plus buybacks. I call this augmented dividends. That makes it 38.54 into 100.50. In other words, 2/3 of my cash in 2014 came from buybacks. I now bring them in. I keep everything else constant, and I come up with the value for the index of 2,332. So in other words, if I use dividends plus buybacks, the index looks undervalued. Weak link, though, is I'm using analyst estimates of growth, and we've said some really mean things. At least I've said some really mean things about analysts. You're saying, how come you're trusting them now? You're right, I should never have trusted them. Is there a way I can replace the analyst estimates of growth? What drives growth in a fundamental growth equation? Retention, what you reinvest times the return on equity. So I did a third valuation where I took the return on equity for the entire S&P 500. I looked at the retention ratio for using buybacks as part of dividends too. So the retention ratio is pretty low. The growth rate I get is closer to 2%. And I revalue the company and I come up with 1992, which is about 5% within. So if you asked me at the start of the year, if you pushed me and said, what do you think about the index? I'd have said, you know what? It's not massively overvalued. It's not massive. It looks okay. I'm cautiously optimistic or aggressively pessimistic. And in fact, I've never been anything other than that with equities. If you're ever more than cautiously optimistic, if you're massively optimistic, something is seriously wrong. That's why you get an equity risk premium, because you have to be cautiously optimistic. There always has to be something that worries you about stocks. If you're not worried, then what the heck am I paying you an equity risk premium for in the first place? So pick your favorite index and actually try this out. It's a very interesting way of answering the question, are Indian stocks overvalued? Are Chinese stocks overvalued? It's a little more messy because there you're looking at only dividends, and you know there's a free cash flow equity that's higher. So if you have the time, because these indices tend to be like, if you take the Sensex, you don't have to do this for 500 companies. It's only 40 companies. You can compute the free cash flow equity for every company and look to see whether an index is cheap or expensive. So 3 valuations, 1 pure dividends, 1 dividends plus buybacks, the third dividends plus buybacks, and fundamental growth. You get a sense at least of where the market is. And for most of the last 25 years, the place I've been is within 10%. The exceptions are in 99 when I did this, you got this 35% overvaluation. In 1999, you took the intrinsic valuation model, you could even get close to the market price. Of course, I've actually used this in a different, when I do my implied premium, here I'm solving for the value, right? With an implied premium, what do? I set the value equal to the index and I solve for the premium. So basically it's the same numbers, and that's why that implied premium spreadsheet has an intrinsic valuation component to it too, if you want to replace the implied premium with what you think is a reasonable equity risk premium. So now let's move over to the dark side. And you're going to see in a minute why I describe this as the dark side of valuation. Okay? Let's face it. If all the companies you were valuing were like Con Ed and 3M, you give me a group of bright 10-year-olds who are curious, I'm serious, I can teach them enough valuation to value companies. In fact, you don't even need a 10-year-old. You can get an app to do it for you, right? Or you can get a spreadsheet to do it for you. So thank the Lord that every company value is not a big money-making stable company, because there would be no need for people to value companies anymore. So let's think about what it is that drives value. And this is a table you saw way at the start of the class. Let's return to it. The value of a company comes from answering 4 questions about the company. First, what are the cash flows you're generating from your existing assets? The second, what's the value added by future growth? Notice how I phrased it, value added by future growth, not what's your future growth, because growth has an upside, growth has a downside. Growth pushes up your earnings, but you need reinvestment to sustain the growth. Third, how risky are your cash flows? And the fourth question is, when will the good times end? Basically, it put you into stable growth. You frame every valuation, those are the questions you ask. And with Con Ed, the questions were easy to answer, right? What are your cash flows from existing assets? It's right there in front of you. It's a regulated utility. What's the value added by future growth? What growth? In fact, by the nature of regulation, you know what Con Ed is required to do? It's required to earn a return on equity roughly equal to the cost of equity. If it earns more, what do the regulatory authorities do? They actually, so the way Con Ed gets price increases, it actually has to go in front of the regulatory authority and say, look, we're not making our cost of equity. The regulatory authority, so for regulated utilities, it's almost by definition you're going to earn roughly your cost of equity or cost of capital. How risky are your cash flows? It's a regulated utility. The revenues are pretty predictable, so the beta was low, the cost of capital reflected. And when will the firm become a mature firm? The firm's already a mature firm. So it was easy to value Con Ed. And you apply the same framework, you can see why it's easy to value 3M. Established business model, you can see what they do, the financials drive the answers to questions. It's when those questions become difficult to answer that you start to struggle, right? And when would those questions become difficult to answer? First, when you're valuing young companies. And you're going to see very quickly, as I ask these questions about a young company, why answering them is so difficult. Second, companies that don't fit the accounting mold. Did I smell mold right? Is that the mold that grows in bathtubs maybe? No, I think it's right. Is that how you spell mold? Like a painter's mold, whatever it is, you know, you kind of get it, right? So I'm not talking about accounting stuff growing on the company, but it's the accounting that the company doesn't fit, nice manufacturing base. And companies that face substantial truncation risk, distress risk, nationalization risk, that's when your valuations get difficult to do. And here are some of the difficult to value companies. In fact, that's what we're going to spend the rest of this session, the next session doing, is valuing difficult to value companies. We're going to start with the young growth firms. Talk about why it's difficult to value them and how you get over it. Then we're going to move on to mature companies in transition. What does that mean? Let's say you're valuing Mondelez. Anybody here valuing Mondelez? Established company. But why is it going to be difficult to value Mondelez? Because they've been targeted by Nelson Peltz and activist investors who want them to change. So you can value the company based on its history, but that valuation might not be the right valuation because the company is going to change under you. Declining and distressed companies, and we'll talk about how to value companies when they're in decline and distress. We'll also look at valuing companies across other markets. And there we have to deal with corporate governance issues, accounting issues, information disclosure issues. And then we'll close off by valuing companies across sectors. We'll look at financial service firms, what makes them difficult. And with each one, you're going to see that 4-question framework start off. And I'm going to use that as my template for why these companies are difficult to value. So we'll look at financial service firms, commodity companies, and companies with intangible assets, pharmaceutical companies, companies that are unconventional. And you're going to see how difficult the 4 questions can be to answer. So let's start this by looking at young companies. I'm a little sick on this one. I really enjoy valuing young companies because the way I see it is, remember the narrative part we talked about last session? It's like being invited in as a writer and asked to finish a book. With a young company, you're being invited in chapter 1. So guess what? You get to tell the story, which is both a burden and a privilege. Because it's a burden because you have to come up with all the characters, you have to lay out the... But let's say that this is chapter 33 of the book, and it's a 35 chapter book, and the author's died, and I call you and say, finish the book. You don't have a whole lot of room to run, right? The book's already been written. So the young companies, you're actually coming in very early in the process. So here's what I'm going to do. I'm going to make you an entrepreneur. You just started up a business, and I'm going to ask you those 4 questions that I need answered to value the company. And you're going to see why valuation is difficult with young companies. So first I ask you, what are your cash flows from existing assets? What's your answer? You say, what existing assets? I don't even own the chair I sit in. That was easy, right? There's nothing there. Okay, 0. Good. Then I ask you, what's the value that you think you can add from future growth? You say a lot. So can you be more precise? Not really, right? You have no history, no product. You might not even have a business model yet, so that kind of becomes murky. Then I ask you, how risky are you? Say, very. Beyond that, you have nothing to show me, right? There are no past prices, no past earnings, nothing, no, all those crutches that we use. Then I ask you, when will you be a mature company? You fall out of the chair laughing. You don't even know whether you'll make it through tonight. You ask me, when will you be a mature company? This is why most young companies never get valued. They get priced. VCs do it all the time. They don't get valued. It's a dangerous game. You price it based on something. What thing? How expensive is your chair? It's a Herman Miller. I'm going to give you $1 billion value. It's just 10,000 times whatever the price of the chair you're sitting in. You're saying, that's absurd. I have to base it on something. You have no revenues, no earnings. I have to base it on something else. It could be users, it could be downloads. You can play the pricing game, but I think if you're investing in the company, you have to think about value. So let's think about how this process gets even more dangerous. Let's say you're valuing a young startup. Here are the 3 places you go to get information to value a company. And this is generically always true. The first is you look at the company's financials, right? Every company, you sit down to value, pull up the annual report, the last 10K, the last 10Q, the prospectus. Then you look at the company's history. Why? Because you can learn from its history. What did it do during the last recession with 3M? I looked at the history to make that judgment that I should be dropping operating income by 10% if there's a recession. And then I look at other companies in the sector. What do I learn by doing that? I look to see what happens as companies age, the reinvestment drop off, what happens to your return on capital. So I look at your financials, I look at your history, I look at the comparables. One by one, let me knock your crutches out. You're valuing a young company, so what do you not have? There's no history. It's early in its life cycle, so your financials tell me nothing about your business model. You're saying, that's okay, I look at the rest of the sector. What if every other company in your sector looks just like you? They're all young companies, early in the life cycle. This is what I call my valuation trifecta. Is when this happens, you're in serious trouble. And this is when the dark side will beckon. Come on over. And here's what it'll whisper to you. The rules don't apply to you. It doesn't matter whether you make money. You talk about paradigm shifts. Basically means you have no idea what's going on. It's a paradigm shift. I don't even know what that means. Okay? You start telling me macro stories. When I ask you, why do you think this company's worth so much? No, why do you think Facebook's worth so much? You start telling me how you're 16-year-old on Facebook every day. So? What am I supposed to extrapolate from there? Or you throw in China. That always helps. And you make up metrics that nobody's ever seen before. You say, I look cheap on a price to chair metric, or price to user metric, or price to download metric. That's the dark side. And if I sound cynical, the next time you hear a VC talking about, do you hear Travis talk about Uber at the end of last week? He talked about the fact that 30% of Uber's rides were coming from China. The China word got thrown in. The fact that he's giving them all away for free to get customers to move to him from Didi Quad, he didn't mention. It's all about rides anyway. So price per ride, Uber is cheap. The fact that you're not charging for the ride, that's bring up these issues. I mean, that's a side issue. But this is the nature of the game when you move over to the dark side. You've lost your anchor, right? Because now you're talking on the terms of whoever brings up whatever metric it is. So I call this the dark side of valuation. My first edition of the dark side of valuation, my book, was actually written for the .com sector. Because here's what would happen. The late 90s, I would give these talks on valuation. And at the end of the talk, somebody would come up to me and say, Amazon.com can't be valued with the DCF model, can it? And they'll have their finger going like this. Please step back, you're going to hurt me. Right? And the risk of grave personal injury, I would say, yes, I think you can value Amazon.com using a discounted cash flow model. And they'd give me this look of total contempt. It's academic. The way they said it, not meant as a compliment. Basically, academic, which basically meant that you really can't do this, you'd like to talk about it. And after the sixth time of being called an academic, I got really pissed off. I said, you know what, I'm going to sit down and value Amazon.com. And the first time I valued Amazon was in 1998. Because it was a .com company in a sector where everybody was like it, no? So essentially the dark side. And I valued Amazon every single year since. It's one of my pet valuations. I return to it every time I feel depressed. Makes me feel much better. And in 2000, actually, AIMR, which is anybody here doing the CFA? My condolences. How many thousands of pages did they make you read this year? Right? It's like an endurance test, like 15,000 pages. What was on page 14,355? You didn't get it? You failed the test. They have this problem. Everybody wants a CFA now, so they've got to fail about 70%. So each year they add a few thousand pages so they can test you on something you haven't read. But that's a different problem. Right? If you go back and look at the AIMR website, in early 2000, they asked me to do a webcast on valuing Amazon, precisely for this reason, because in early 2000, this was January 2000, the .com boom was at its peak, and the question that people are asking is, how do you value a .com company? They said, can you do a webcast? It was one of their first live webcasts. It's a 30-minute webcast, so I'm going to compress it and give you how I valued Amazon in early 2000. Now to set up the picture, in early 2000, here's what Amazon looked like. It had revenues of 1.1 billion. Which for a US retailer are small revenues, and an operating loss of $410 million. So a company with small revenues and big operating losses, before you even value Amazon, let me ask you a question. Can a company with small revenues and big operating losses become a valuable company? Sure, right? So help me out here. What's got to happen to the small revenues? They have to become big revenues. I know this is incredibly simplistic, but hang in there. What's got to happen to the operating losses? They have to become operators. So the signs got to change. So if I can somehow make small revenues into big revenues and operating losses into operating profits, my problem goes away, right? So here's the first big assumption I made. I assumed a compounded revenue growth of 42% a year for the next 10 years. So why 42%? I'll come back and talk about it because that's going to be a key assumption. But that 42% growth is going to make, as I was doing this live webcast, remember the early days of live webcasts, people would email questions. They'd thrust the questions in front of me while I was doing the webcast. Very distracting. I hadn't even finished saying 42%. The first question comes in. How come you're being so pessimistic about future growth? I said, what? I'm making $1 billion in revenues into $40 billion in 10 years. I'm making the revenues grow 40-fold. And you're calling me pessimistic? You know why it sounded pessimistic to them? What were they comparing the 42% to? The revenue growth in the most recent year, which was 200%, they missed the compounded in the 10 years completely. I actually was estimating revenue growth of 150% in year one, but I had to scale it down, not because I didn't like Amazon, but because the company was getting bigger over time. So I thought I was being pretty optimistic. I was making Amazon a very large retailer. So half my problem is now solved, right? I made small revenues into big revenues. On a spreadsheet, it's amazing what you can do. What's my second problem? I have this margin of minus 37%. I said, this can't stand. If it does, I know exactly what Amazon is worth. The duh proposition kicks in. The company's worth nothing, so I've got to make it positive. So I targeted an operating margin of 10%. I'll come back and back up why 10%, because that's a critical number. It's going to make my negative margins into positive margins. So as my negative margins become positive margins, my losses become profits. Magically on my spreadsheet, I've made this company go from being a small money-losing company to a big money-making company. There's a third loose end I've got to tie up. I know getting revenues from $1 billion to $40 billion is going to take work. It's going to take more than work. It's going to take money. Remember that big reinvestment thing that we said when we were talking about growth, that you need to reinvest to sustain growth? And Amazon was one of the first companies where I wrestled with this question. I tell people I learned more about valuing companies by valuing Amazon in 98, 99, and 2000 than any other company I've ever valued. Because I wrestled with, how do I get growth for a company? I initially tried that fundamental growth, return on capital times reinvestment rate, and I very quickly realized this wasn't going to work for me. Why? Because the return on capital is a big negative number. The reinvestment rate is a big negative number. You're saying this is very, very convenient. Big negative times big negative is big positive. But if I put a positive growth rate on an operating loss, it's just going to get more negative. So here's what I did. This is when I concocted that sales to invested capital ratio that you see on my spreadsheets today. And the reason I had to attach my reinvestment to sales, it's the only number that really is positive. And it's desperation time. That's what drove me to sales. So what I did each year was I took the change in sales and I applied a sales to capital ratio of 3. So the big numbers here, the compounded revenue growth makes my small revenues into big revenues. My target margin, which is positive, makes my losses into profits. My sales to capital ratio allows me to estimate my reinvestment each year. And the bottom line that you see here is my free cash flow to the firm under my optimistic valuation of Amazon. And what do you see for the first 6 years? Negative, 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 negative. So what am I implicitly assuming that Amazon's going to be able to do in year 1, year 2, year 3, year 4, year 5, and year 6? Raise money. Sometimes we make implicit assumption. Early 2000, I didn't even think twice about it. I acted like capital markets would always stay open and accessible, and that they could raise money to cover their deficits. Which means this discounted cash flow valuation is a going concern value for Amazon. Do you see where I'm going next? With young growth companies, what do you have to worry about? What if I don't make it? I wasn't even thinking about that in early 2000, and I should have. But I was caught up, and this is where the mood of the moment gets into you as well. What can go wrong with a .com company? Everybody loves them. They always supply capital. Now, to discount these cash flows, I need costs of capital. Not one cost of capital. Why? Because on my spreadsheet, what's happening in the company? It's going from a young, money-losing, risky company to a large, money-making retail company, right? And here's how I reflected that. When I started the valuation, I made an almost all-equity company. Why? Because they could not service debt. And I gave them a beta 1.6, reflecting the betas of online retailers then. Risky companies, young startups, high fixed costs. And as the company changed on my spreadsheet, that beta, which was 1.60, starts drifting towards 1. So starting in year 5, I start moving the beta towards 1, because that's a beta for retailers in general. Because as I think I mentioned this about social media companies as well. There is no business called .com. .com is a distribution mechanism, a way of doing something. This is a retail company. You can dance around as much as you want, at least in early 2000. Now it's actually an interesting question as to whether Amazon is a retailer or whether it's an entertainment company, right? So in a sense, you could argue now that it is in two different businesses, because Amazon Media, Amazon Phone, etc., you're going into multiple businesses. In early 2000, the end beta that I gave them was a beta for a retail company. Which means as my beta changes, the cost of equity decreases. And to complete the picture, since my beta is changing, the company is changing, I said, hey, why shouldn't the debt ratio change as well? Initially, they can't borrow money. Why? Because not because they don't want to, but because they can't afford to. But as they make more money, I moved that debt ratio from 0% or close to 0% to 15%. Remember what I said? You come in early in a book. It's your book to write. Jeff Bezos also contributes a little bit. But it's your book to write, and of course, he's going to deliver the message saying, that part of your book is not working for me. You better listen to him, because he's the one tweaking he's the real-life character. This is like a reality show mixed in with a novel. You've got to watch the reality character, because if it's Kim Kardashian, who knows what she might do. But your job is to bring that into your valuation. So there's my cost of capital, starting at 12.84%, dropping to 9.61%. I discount. Oh, one more thing. Notice that for the first 3 years, my EBIT and my after-tax EBIT are identical? Why am I not paying taxes in year 1 and 2? The answer is easy, because I'm losing money. Why am I not paying taxes in year 3 when I'm making money? Because I have an NOL carried forward. In my discounted cash flow valuations, the NOLs show up in my cash flows. I'm not carrying this extra NOL because the way an NOL helps me by saving me taxes in future years, and that's built into my cash flows. So I discount the cash flows back at the costs of capital. What I get is, and don't forget the big nirvana at the end, right? I get to year 10, I'm a nice mature company making lots of money, I give it a big terminal value. I discount it back, I get a value for the operating assets of 14.9 billion. Add cash, subtract our debt, I get a value for the equity of 14.6 billion. I'm almost there, right? You get ready to divide by the number of shares, but remember what we said about options. Options are another claim on your equity, and Amazon through its growth period has been giving away options like they're free currency. So if during the option session you're saying, why are we wasting time on this side issue? Here's why. Look at how much of your value has been given away. Amazon options valued as options are about $2.9 billion. I'm going to subtract them out. Why? Because as a common stockholder in Amazon, that's another claim that's been put on my equity. I divide by the number of shares, I get $34 per share. I thought I had my optimist hat firmly on through this entire valuation, right? Small revenues to big revenues, losses to profits. I'm assuming that the capital markets stay open and accessible, cost of capital drops to that of a mature company. See why I'm emphasizing my optimism? Because the end of the process, when I compare to the market price is 84. There is this canard about discounted cash flow valuation that you can make a DCF value give you any number you want. Technically, that's true. But there are companies where I've done DCFs and I've said there's no way that I can come up with a credible discounted cash flow value that's even close to the market price. It doesn't happen that often when you're able to categorically make that statement. In early 2000, that's what I would have said about Amazon. So ask me the question. If I believe my valuation, what should I be doing next? You see, buying puts, what's the problem? CBOE, you're going to get, what, 2 months, 3 months at the most. Selling short, you could, but in fact, you put your finger on why taking advantage of this is difficult to do. If you buy puts, you got 3 months. What has to happen within the 3 months? The market's got to correct. If you sell short, and in fact, I knew this question was coming, so I called around. And the most that a broker would give me was 6 to 8 weeks, because .com stocks, because what does selling short mean? You borrow somebody's shares and agree to return them. 6 to 8 weeks. You see why I did nothing? This is asking for trouble. And it's not because I don't feel confident about the company being overvalued. It's because there is no long-term pathway available to me to make money of that overvaluation. It's one of the great asymmetries in investing. When something is undervalued, there is a bargain basement strategy, right? You come in, you buy, you hold for how long? Until your spouse asks, when the hell did you buy that? You say, I don't know, the kid must have bought it. I don't know, it's not my problem. But if you control your time horizon, it is your time horizon. So if I thought that something was cheap, I can buy Volkswagen and I can let it ride. I can let it ride through all the bad news that I'm sure will come out over the next 6 months, until the next car company does something scandalous, in which case the spotlight will shift. It's only a question of time. For Toyota does it, Mazda does it, Ford does it, GM does it. But I have the luxury of waiting. But if I think Shake Shack is overvalued, or GoPro is overvalued, and I thought both are overvalued a year ago. I wish I'd sold short on GoPro after the fact, but really not. Because in a sense, when your time horizon is controlled by somebody else, it becomes much more difficult to take advantage of a valuation, even if you feel confident about it. So I'd like to use my Amazon valuation to bring home some lessons about young companies in general.
The previous slide, we could move the value up by changing the 6% long-term growth rate through changing the reinvestment assumption.
But then you'll have lower cash flows. Will that increase your value or decrease your value? So when you say previous slide, what are we talking about?
On the slide, yeah, this one.
Yeah.
We have a stable growth rate of 6%,
Yeah.
which is driving a lot of
Which it's actually not the stable growth rate, it's a return on capital. So if you want to change the value, that's the number you need to change, is the 20% return on capital. Because that's a big assumption. So that's part of the optimistic story. Not only am I giving them this great stuff for the next 10 years, and beyond year 10, I'm saying once they're an established online retailer, they're going to have significant competitive advantages which will allow them to earn a 20% return on capital. Okay? So I'm going to use this valuation to bring home some lessons I learned in the course of this valuation. The first was a lesson that I'd kind of got already. I've never trusted regression betas. And those of you who've been in my corporate finance class know how much I beat them up. And I've always been a believer in using bottom-up betas. That lesson goes in spades if you're valuing a young growth company. Do not value Shake Shack using the beta that you get from Bloomberg over the last 2 years. You will get nonsense. Don't value GoPro using the beta you get over the 6 months. It is meaningless. So if you're using sector average betas, it's even more critical that you do it. But it does mean that you have to tell me what business your company is in. So when I valued Twitter, I had to make that decision. It's an online advertising company, and look at the betas based on business. So you have that obligation for valuing young companies to put it in a business, come up with the beta for that business. So that's the first thing. And you can see how much the regression beta reflects the noise. There's the Amazon's regression beta 2.2. Look at the standard error in that estimate. 0.50. Think about statistics, right? Basically, the true beta for Amazon could be anywhere from 1.2 to 3.2. Fat lot of good that does you. Second, we talk a little bit about how I got that 42% growth rate, because maybe it'll give you some insight into thinking about what growth rate to use for your company. You're valuing young companies. Do not work sequentially. You know what I mean by sequentially? Normally we take year 1, then we do year 2, then we do year 3, then we do year 4. If you do that, by the time you get to year 4, you're going to be pulling all your hair out and going crazy. Why? Because it's uncertain. So I'm going to suggest something really weird. I'm saying, if you have a young growth company, rather than think about year 1, year 2, year 3, think about year 10. How the heck am I going to think about year 10 if I don't know year 1, 2? Think about what your end game is. What do you think this company will look like if it succeeds? You're saying, what if I'm pessimistic? Don't value young growth companies. You're one of those naturally pessimistic people, stick with Procter & Gamble and value it over and over again. Because the young growth company, you're going to say, no way is this company ever going to make it, which is perfectly consistent with your pessimistic view of the world. So you've got to get your optimist hat on and say, what do I visualize success for this company to look like? And that's what I did for Amazon. I said, I like the company. I know it's a retail company. And then I took the 10 largest retailers in 2000, none of whom are .com retailers, and said, where do I think Amazon's going to end up at the end of a decade if they continue to move on the path? So I like their management, I like the company, and the way I reflected that is I made Amazon the 6th largest retailer in the world by the end of year 10. That gave me revenues of $40 billion. Because basically I had to go to the table 10 years. Now do you see what the rest of the... all I have to do is fill in the middle, right, to get from 1 to 40 billion. So where are my revenues? There's my revenues by year. And I start with 150% growth rate, then I go to 100, then I go to 75, then I go to 50. So that's how I get these revenues. Saying, how do you come up with those numbers? I'll make a confession. I made them up. And if you really have an issue with my year 1 growth, you can have it. You want to use 162.33%? Go ahead. You want the year 2? You can have that too. You give me the starting and the ending numbers, the billion and the 40. You can have the middle numbers. Do you see what I'm saying about young growth companies? People get so focused on, did they meet their revenues in the last 6 months? This is silly. This is like when your kindergartner walks in with the report card, you take a look and say, oh my God, you're never going to college. Hey, don't you think you might be overreacting here? That's what that earnings report from a 6-month-old company is. It's a kindergarten report. You should be thinking end game. So if this kid is torturing other kids on the playground, then worry. But if it just says conduct unbecoming of a 6-year-old, hey, maybe he's going to be a disruptor. That's going to be value creating. Let him go, right? Yeah. So that's how I got those revenues, is by starting with the end and working backwards. So that's what I wanted to think about. The young growth companies is, think about the business it's in. Think of what success will look like. I'm not saying it's going to be easy, but here's how you should console yourself. You're not the only one facing this problem. The CEO of the company is not much more informed than you are. They all have these fuzzy numbers. Make your best judgment. You can always come back and change it. Then I took the operating margin. And we did this with Sirius too, right? Where you start, the starting margin is minus 36.7. My ending margin is 10. That's all the numbers I had. The ending margin I got by looking at what brick and mortar retailers were making as operating margins in their businesses. So I know where I am, I know where I want to end up. I have this empty space in my spreadsheet, year 1, year 2. And here's what I hoped and prayed. I said, please God, fill in those 10 years for me. Because I don't want to estimate the margin in year 1 and year 2. And I got my prayers answered. The spreadsheet filled in the middle. I had to help it out a little bit. I created an algorithm that essentially let the spreadsheet fill in the middle 10 years. You know what the algorithm was? What's my starting number? Minus 36.7. What's my ending number? 10. What's the distance? 46.7. I took half the distance. Saying, that is so simplistic. Guilty as charged. I've got minus 13.35. I need to get to plus 10. I took the difference. I moved halfway. If you go to the spreadsheet that contains this valuation, still on my website, I'll let you change that number from half to a quarter. If you change a half to a quarter, what's going to happen? I'm still going to start at minus 36.7. I'm still going to end at plus 10, but I'm going to have a longer period of losses and bigger losses. This is the simplest device I could think of, where if you disagreed with me on the pathway to profitability, you can change the number. I say this often, and people have no idea what I'm talking about. I'd rather be transparently wrong than opaquely right. Transparently wrong in what sense? If I'm wrong, I want to see that's where I screwed up. And if you think I'm wrong, I want you to be able to fix that number. And this is the simplest device I could think of. So that basically allowed me to get the margins. And that's what gives me my losses to profits. And this is a lesson we'll repeat over and over again. Scaling up is hard to do. Is there a song that's breaking up is hard to do? No, but basically there should be somebody who sings a song. Scaling up is hard to do, and blast it out loud when you're valuing young companies. Because as you get bigger, it gets more and more difficult to keep growing. So let me end with this. This is actually a graph that looked at IPOs, companies that have just gone public, and compared their revenue growth rates to the revenue growth rate of the sector that these companies operate in. So 1 year after going public, these companies report 15% higher growth. 2 years after, they report 7% higher growth. 3 years after, they report... See what's happening, how quickly these young growth companies start to converge in the sector? By the time you get to 5 years after, you can't tell these companies apart from the sector. That's why I stay at a 10-year growth period, because as you get past 10 years, you're looking at the exceptions rather than the rule. Most growth companies, in 5 years, very quickly converge in the average. So let's stop there. When we continue, I'll finish the last few lessons, then we'll move on to mature and declining companies.